Trump's tax bill advances, but at what cost? President Trump's sweeping tax and spending bill finally got the green light from US lawmakers after a series of overnight votes. But what the president called one big beautiful bill will also add $3.8 trillion to the $36.2 trillion US debt burden over the next decade. And that's having an impact on the bond market. The yield on the 30-year Treasury rose above 5.1%, its highest since October 2023. Well, Russ Mould is investment director at AJ Bell. Russ, the president is probably breathing a sigh of relief, but what about the markets?
Yeah, they're not quite so keen. I think share prices, although they look unhappy, probably should be grateful because there's a case to be made that the huge government deficits in the end are helping to support spending that is in turn supporting corporate profits. So they might need to be a bit careful what they wish for there. But as you say, it's the fixed income market that's unhappy, looking at this prospect of more government borrowing, more supply of treasuries, and generally more supply means lower prices. But also there is this suspicion that Treasury Secretary Percent and President Trump want to run the American economy hot, get nominal GDP growth growing faster than debt, so the debt to GDP ratio magically comes down. But again, if they're letting inflation run, maybe even 4 or 5, 4% plus on a 10-year Treasury isn't going to be enough compensation to keep bond vigilantes happy.
But there's already been quite a bit of damage, not just to the US Treasury market, but the dollar too. What's your analysis of all of this?
Yeah, I must admit, my record on currencies is awful, Ramzan, even worse than it is on oil, so you probably don't want to listen to me. But certainly the dollar has been conspicuously weak. The DXY index, I think, has briefly gone below 100. So all of the gains made post-Trump's win back in autumn and then have gone and then more. And there does seem to be some increased wariness of holding dollar assets, either because some people are concerned over the debt situation, they're concerned over potential inflationary policies, or indeed, dare one say, a president who seems quite happy to rule by social media posts, which is unconventional even if he views it as effective.
Now, how will this all impact on the Fed going forward? Can you see a delay in perhaps the next rate cut?
Well, the president is continuing to call for cheaper money and lower rates, as he's consistently done during his 2 terms in office. But the Fed has already cut by 75 basis points, and bond yields, treasury yields, have gone up. So again, there's clearly this concern the Fed has acted precipitately, maybe gone a bit too far, too fast even. And it could have been a no-win situation. Even if it does cut to boost the economy, bond vigilantes may take offence and push yields higher still. So it's a very finely balanced situation.
Well, let's turn to Europe now, Russ. And the latest PMI for the region's largest economy, Germany, well, it didn't really make for pretty reading. Business activity fell in May, but the downturn for British firms eased. What's your take on this differing picture?
Yeah, again, that means where we have this sort of different interest rate picture developing. The ECB, after the weak EU composite PMI number today, now expected to cut maybe 3 times this year, starting at the meeting in early June. The Bank of England, after that sticky inflation reading yesterday, economy may be hanging a bit tougher. Just 1 cut is expected, and that is feeding through to currencies. The pound is moving back towards 120 against the euro. That would be a 7-year high, and the euro is losing a little bit of ground even against the greenback today as well.
Well, let's have a quick look at some corporate news now. And Nike looks to set to raise its prices and put their products back on Amazon. What do you think is the motivation behind these moves?
I think the price increases, the company saying, are the function of tariffs. President Trump has consistently said he thinks that those doing the shipping should pay, and the companies, or if they don't, the company should eat the price increase, the cost increase. That doesn't seem to be happening, so he might not be very pleased. And the move to Amazon, Nike's move to go more to try and drive sales through its own websites and stores just hasn't really worked that well. So they've been looking to expand their reach. Intriguing to see Nike shares up, but also JD Sports Fashion here in the UK. Its shares are up more. There was always been fears that it might perhaps not be able to do as much Nike business. So a bit of a sigh of relief there for a share price that's had a real hammering in the past year or so.
That was Russ Mould from AJ Bell. And don't forget, you can watch more videos on Reuters.com.